Welcome to the deep dive. Today we're jumping right into the world of trading, really looking at the ideas of Jesse Livermore. Many consider him, maybe the greatest stock trader ever.
Yeah, absolutely. And we're digging into his whole trading system, something he refined over, what, 45 years in the markets?
That's right. Our main guide here is the book Trade Like Jesse Livermore, which really unpacks how he did it, the methods behind those legendary trades.
Mm-hmm. It laid us all out.
So, the goal for you listening today, our kind of mission, is to pull out the core pieces of Livermore's strategy, how he
Yeah.
timed things, how he managed risk.
And the amazing thing is how relevant it still feels,
Yeah.
even with all the tech we have now, right?
Totally. It's easy to look at his huge wins, like, what was it, $3 million in one day back in 1907,
Yeah.
and $100 million in 1929. Easy to just call it luck.
Right. But it really wasn't just luck. When you look closer, you see this very disciplined system he built.
Exactly. And that's what we want to unpack today, that system.
Let's do it.
Okay, so where did it all begin? His background wasn't Wall Street, was it? Born on a farm, New England.
Yeah, late 1800s, farming family. But apparently he had this natural knack for numbers and definitely didn't want to be a farmer.
I can imagine. So he escapes the farm.
Pretty much runs away at 14.
Hmm.
Ends up in Boston, gets a job as a chalkboard boy at PaineWebber.
A bored boy. So just writing stock prices.
Yeah, but think about it. He's immersed, constantly seeing the quotes change, the flow of the market minute by minute.
Right. And that constant exposure, it did something.
It clicked for him. He started tracking the numbers in his head, seeing patterns where others just saw noise really quick.
Wow. And he started keeping notes. Secretly.
Uh-huh. Kept a trading diary his whole life, apparently. Started right then. Jotting down observations, things he noticed, ideas that later made him millions,
That's incredible. And didn't his boss give him some early advice? Something about having skin in the game?
Yeah, that was key. His boss saw his interest and basically said, look, to really learn this, you've got to put your own money on the line.
And did he?
Oh, yeah. It changed everything. Suddenly, it wasn't just numbers on a board. It was real. He felt the pressure, the emotion, and, crucially, found he could handle it.
So that leads him to the bucket shops, right? At only 15, what exactly were those places?
Bucket shops.
Yeah.
They weren't like proper exchanges. You were essentially betting on price movements, not actually buying or selling stock. Think of it like a casino for stocks.
Okay. And he did well there.
He did really well initially because the execution was instant. If the tape said 50, he could bet at 50 right away.
Ah, but that changed when he moved to the actual Wall Street firms.
Big time. On the real exchanges, there were delays. Order execution wasn't instant. That slippage, as they call it, meant he often couldn't get the price he wanted.
Right, and that messed with his system.
Completely.
Yeah.
Plus, Wall Street offered more margin, more leverage.
Which sounds good, but
Yeah,
dangerous.
exactly. Too much margin meant he could hold on to losing stocks way too long. Hope took over, instead of cutting the loss.
So that's where the 10% rule came from. Cut your losses quick.
Pretty much. He realized early on, probably through some painful losses, that limiting any single loss to around 10% was vital. Survival depended on it, protecting his capital mentally too.
And he saw these early wipeouts not as failures, but as education.
Yeah, tuition fees for his trading education, he called it. He was constantly refining his system, learning from mistakes. That mindset was key.
Okay, let's pivot to timing, because this is where Livermore really stands out. Buying on new highs, selling short on new lows. It sounds wrong.
It sounds contrarian, definitely.
Yeah.
The standard advice is buy low, sell high. But Livermore believed the market itself tells you what to do.
Through the ticker tape.
Exactly. He wasn't trying to predict the future. He was reading the tape's message right now. A stock making new highs consistently. That's strength. That's momentum. Why bet against it?
So follow the trend. Trade with the wind at your back, as the saying goes.
Precisely. Don't fight the tape. If a stock is weak, making new lows, that's a signal too. Maybe a shorting opportunity.
Can you quickly explain short selling for anyone unfamiliar? How he used it?
Sure. Shorting is basically betting a stock will go down. You borrow shares, sell them immediately, hoping the price drops. Then you buy them back cheaper later, return them to the lender, and keep the difference. Livermore did this when the trend was clearly down.
Got it. Now, what about news? We're swimming in news today. How did Livermore view news in relation to his trading?
He was very skeptical. He found news often unreliable, maybe biased, and its impact totally unpredictable.
Like, good news doesn't always mean the stock goes up.
Right. Maybe it was already priced in. Or bad news gets ignored in a strong bull market. He trusted the price action, what the stock was actually doing, way more than headlines.
So price action over news. And patience seems like a huge part of this timing aspect, too. He wasn't impulsive.
Not at all. Patience was critical. He'd wait, sometimes for ages, for the perfect setup, for confirmation, even if it meant missing the absolute bottom or top by a bit.
Better to be sure than sorry.
Exactly. He used to say trading opportunities are like streetcars, miss one, another will be along soon. No need to chase.
He looked for stocks consolidating, moving
Right.
sideways, right, and then waited for a breakout.
Yes, consolidation ranges were important, a period where buyers and sellers are kind of balanced. Then a breakout from that range, especially on higher volume. That was a key entry signal.
Why the high volume? What did that signify?
The volume confirmed the move. It showed conviction, lots of participation, meaning the breakout was more likely to be real and continue. Low-volume breakouts are often false moves.
Okay, and this idea that he needed to be correct in the trade right from the beginning, what does that mean in practice?
It means if he bought a stock based on his signals, he expected it to start moving his way pretty much immediately. If it just sat there, or worse, ticked down against him,
Red flag.
big red flag, it suggested his timing or analysis was off. The premise of the trade wasn't working out as expected.
Which leads directly to cutting losses quickly. No holding on and hoping.
Absolutely not. If the trade didn't act right, it was a mistake. Admit it, cut the loss, move on. Selling discipline was just as vital as buying discipline for him.
It sounds like a constant fight against basic human emotions like hope and fear.
Oh, totally. He called hope and fear the speculator's worst enemies. Hope keeps you in losers too long. Fear makes you sell winners too soon. He aimed for cold, calculated execution based on market action.
Let profits run, cut losses short. Simple, but hard.
Very hard. But he stressed letting winners ride as long as the stock's action justified it. Be fearful only when a stock immediately goes against you after buying.
He had a term for people who let losing speculations turn into long-term holds, didn't he? Involuntary investors.
Yeah. People who bought hoping for a quick profit, but then the stock drops, and they suddenly decide they're holding it for the long term. A dangerous trap, he thought. Ties up capital.
And that famous quote, "There are no good stocks. There are only stocks that make money," really sums up his unsentimental view.
Perfectly. No emotional attachment. Does the stock's action suggest it's going up? That's all that mattered. Is it making me money right now? Speculation shouldn't become investment just because it went wrong.
He even argued that supposedly conservative buy and hold investors who just ignore warning signs often take the biggest hits eventually.
Yeah, he saw active traders taking small, controlled losses frequently. But the investor who ignores clear signs of trouble in a company or sector could face devastating, catastrophic losses down the line. Discipline was safer, in his view.
Okay, let's shift a bit. He didn't just look at individual stocks, right? Industry groups were crucial.
Absolutely crucial. He believed you had to understand the group first. Is the whole industry strong or weak?
So buy strong stocks and strong groups.
That was the ideal scenario.
Mhm.
And potentially short weak stocks and weak groups. Ride the sector trend. It stacks the odds in your favor.
And within those groups, focus on the leaders.
Generally, yes. The leading stocks often move first and furthest, though he did note exceptions. Sometimes one dominant company, like an Intel or Microsoft back in the day, could basically be the group.
Interesting. And this led to his top-down trading approach. 4 steps.
Right. Step 1, check the overall market trend. Is it bullish, bearish, sideways?
Okay.
Step 2, analyze the specific industry group. Is it stronger or weaker than the market, moving up or down?
Makes sense.
Step 3, he used something called tandem trading. Compare your target stock to a close competitor in the same group. Is yours leading or lagging?
Like a relative strength check within the group.
Exactly. Step 4, put it all together. Market, group, tandem comparison, do they all align? If yes, much higher confidence trade.
So seeking confluence, everything pointing the same way.
That's the idea. He used this not just for entries, but to spot major market turns too, like in 1907 and 1929.
He mentioned watching copper and motor stocks weaken in the late 20s as a warning sign, right? Although he jumped the gun a bit initially.
Yeah, that's a great example. He saw those key groups roll over and started shorting aggressively. But maybe too soon, across too many things.
What did he learn from that mistake?
He learned that while lead groups give clues, you need broader confirmation. Multiple sectors need to turn down to confirm a major bear market is starting. Patience again, even on the short side.
Okay, let's dive into his specific timing tools. Pivotal points. What were these exactly?
Pivotal points were key price levels, sort of psychological moments, where he felt a significant move was highly probable. The main type was the reversal pivotal point, signaling a potential change in the trend.
And again, not about nailing the exact top or bottom, but finding the right time to enter with high odds.
Precisely. It demanded patience, waiting for that specific price action, that pattern, to form clearly at a potential turning point. If the setup wasn't perfect, he'd wait.
And these could signal short trades too, not just buys.
Oh yeah. A reversal pivotal point could mark the top of a rally in a downtrend, signaling a good short entry just as easily as it could mark the bottom of a decline.
Then there were continuation pivotal points. How are they different?
Continuation points confirmed an existing trend was likely to keep going. So a stock's in an uptrend, pulls back or consolidates for a bit, forms a little base, then breaks out upwards again from that base. That breakout point is a continuation pivotal point.
Another potential entry point to add to a position or get in if you missed the first move.
Exactly. But crucially, you had to wait for the breakout confirmation. Don't anticipate it. If it broke down from the consolidation instead, the setup was invalid.
He also talked about false pivotal points as shorting chances.
Right. Imagine a stock makes a new low, then bounces weakly. But that rally fails, and the stock rolled over and breaks below the previous low again. That failure, that break of the prior low after a weak bounce, that's a false pivotal point. Strong signal the downtrend is resuming. Good short entry.
It always comes back to waiting for the market to prove the point, doesn't it? Only trade on these pivotal points when everything aligns.
That was his mantra. Discipline, patience, wait for the high probability setup confirmed by the tape, supported by the group action and the overall market. Stack the odds.
Beyond pivotal points, he watched other patterns too, like spikes and one-day reversals. What were those telling him?
These were often warning signs. A sudden, sharp price spike on huge volume, especially after a long run-up. That could be a blow-off top, often followed by a one-day reversal.
And a one-day reversal is.
It's where a stock makes a new high for the move, higher than the previous day, but then closes lower than the previous day's close, usually on very high volume. Big warning sign. Trend might be exhausted. Reversal coming.
So not necessarily a sell signal on its own, but a pay attention signal.
Definitely. It showed strong selling pressure coming in to meet the buying climax. Time to be cautious, maybe tighten stops, or prepare to exit if it breaks down further.
Conversely, a breakout on new high was a very positive signal for him.
Very bullish, yes. When a stock breaks out decisively to a new high price level, especially after consolidating, he saw that as overcoming resistance. Strong potential for a significant run higher. Same logic for breakouts to new lows on the downside.
And volume was always part of the equation with these patterns.
Always. Volume was the confirming indicator. A breakout on weak volume is suspicious. A reversal on high volume is significant. Changes in volume alerted him to potential shifts in supply and demand.
Lastly, he mentioned saucer patterns, longer-term formations.
Yeah, saucers are slow, gradual bottoming patterns. Price drifts down, then sideways for a long time, slowly rounding upwards like a saucer shape. It indicates sellers are exhausted, and buyers are gradually accumulating shares over months, maybe even years. Signals a potential major long-term bottom.
Requires a lot of patience to trade those. Okay, let's shift to maybe the most crucial part after timing, money management. Livermore was ruthless here, wasn't he?
Absolutely essential. You can have the best timing, but without managing your money, you'll blow up. His #1 rule, always keep cash reserves. Ammunition, he called it.
Why was holding cash so important, not being fully invested?
Because the big, easy money opportunities don't come along every day. You need cash ready to deploy decisively when those high-probability pivotal point setups appear. If you're always fully invested, you can't capitalize.
Right. Being patient with cash is part of the strategy.
Exactly. Time is time and money is money. Sitting in cash wasn't wasting time. It was waiting strategically. And he had this view about profits, too.
That they weren't really yours until you banked them.
Pretty much. While the trade was open and in profit, he felt like he was playing with the market's money, which helped him stay cool. But it wasn't real until closed out. Kept him grounded.
He wasn't a fan of cheap stocks either, was he? Especially in bad industries.
No, he thought cheap was often cheap for a reason. Focus on the leaders, the strong stocks and strong groups, even if they looked expensive. Don't bottom fish in depressed industries hoping for a turnaround.
Keep capital liquid and working. Don't get stuck.
Right. Avoid being loaded up permanently. If a stock isn't working, get out. Free up the capital for the next opportunity. Stay flexible.
He also ignored insiders and company statements. Why?
He felt insiders were often biased, too close to things, or had agendas. And executives, their job is to paint a positive picture. He trusted the objective message of the market, the price and volume action far more.
And before any trade, he set targets and stops.
Always. Before entering, know your profit objective, calculate your risk-reward ratio, and crucially, determine your stop-loss point based on the pivotal point or pattern.
Takes the emotion out of it later.
That's the goal. Trade like a business, like an automaton, following rules. Know your exit points both for profit and loss before you get in.
Which brings us back to cut losses quickly and let profits ride. The core idea.
Absolutely. It's about asymmetry. Keep losses small and contained. Let the winners grow into potentially huge gains. That's how you make big money over time. One big win can pay for many small losses if you manage it right.
He also used pyramiding, adding to winners.
Yes, but very specifically, he'd add to a position only when it moved further in his favor, usually at higher prices after crossing certain points. It confirmed the trend was strong.
So averaging up, not down.
Never average down on a loser. That's throwing good money after bad, he believed. Only reinforce success by adding to winners.
And fundamentally, what did he see driving prices long term?
Ultimately, earnings, profits, and the potential for future profit growth. That's what underpins sustainable price increases, even if short-term moves are speculative.
He also warned against letting others trade your money and limiting risk per trade.
Yeah, he believed you had to take responsibility yourself and never risk too much on one single idea, no matter how good it seems. Protect your overall capital, diversify risk across trades.
And that interesting psychological tip, take some profits out periodically as real money.
He found it helpful. Physically banking some winnings reinforces success, maybe makes you less likely to gamble it all away, a psychological anchor. And always focus on the strongest stock in the strongest group.
Okay, timing and money management are huge, but then there's the mental game, emotional control, preparation.
Just as important, maybe more so, Livermore knew the biggest enemy was usually yourself. Greed, fear, impatience, ignorance, hope. They wreck traders.
Learning from losses was key for him.
Absolutely. And treating trading seriously. People are more careful buying a car than risking their savings in the market sometimes.
Yeah.
He hated stock tips too.
Why so against tips and inside info?
He saw them as poison, unreliable, often spread with bad intentions. Success comes from your own hard work, studying the market, figuring out its puzzles yourself, not shortcuts.
And he needed focus, a quiet space, away from the brokerage office buzz.
Oh yeah, he had a private, quiet office, minimized distractions. He couldn't think clearly amidst the noise, the opinions, the emotions of a trading floor or brokerage. Needed isolation to focus on the tape.
Preparation was key, too, mentally, physically.
Definitely. Treat it like a high-performance activity. Be rested, focused, have a routine, plan your day, minimize distractions so you can make clear decisions when it matters.
Let's wrap up with some general Livermore wisdom. He felt the market looks ahead, right? Discounts the future.
Yes, future time, he called it. The market often anticipates economic news. By the time the report comes out, the move might have already happened. Price action is often a leading indicator.
And selling stocks that just do nothing. Listless drifters.
Get rid of them. Opportunity cost. Capital tied up in a stock going sideways is capital that can't be used for a stock that's actually moving. Keep your money circulating in active situations.
Patience and cash again, waiting for the real opportunities.
Always comes back to that. Patience to wait, cash to act.
He also believed market patterns repeat. History echoes.
Strongly. Price movements aren't entirely new. Human psychology doesn't change that much. That's why studying past patterns, keeping records like he did, helps you anticipate future moves.
And that great line, markets are never wrong, opinions often are.
Classic Livermore. Humble yourself to the market. If the price action contradicts your opinion is wrong. Dump it. Follow the market. Don't argue with the tape.
Wait for the market to confirm your idea before acting.
Yes. And he found the best trades, the really big winners, often showed a profit right from the very start.
Interesting, like immediate confirmation.
Kind of. It suggests your timing was spot on. He also advised really getting to know a few stocks or groups intimately. Combine timing and price action.
And that specific entry signal. Buy when a stock makes a new high on its movement after having had a normal reaction in an uptrend.
Yeah, that's a classic continuation pivotal point setup. Pull back in an uptrend, hold support, then breaks out again to resume the climb. High probability entry for him? Don't wait for news to explain it. Act on the price signal.
Okay, so wrapping this deep dive up, the big takeaways from Livermore seem clear. It's that intense focus on timing, pivotal points, trends, group analysis.
Absolutely. Coupled with iron discipline and money management, cut losses, let winners run, hold cash.
And underpinning it all, that crucial emotional control. Managing fear, greed, hope.
And what's amazing is how relevant it all still is. These principles, figured out a century ago without computers, still offer huge insights for today's markets.
Definitely. So maybe a final thought for you listening. How can you apply Livermore's idea of listening to the market's own language? Price, volume, patterns. How can that help you cut through the noise and form your own clear view? What music is the market playing for you right now? As Livermore knew, figuring that out takes your own observation, your own study.
Well said. It's an ongoing process.
Thanks for joining us for this deep dive.